All right. Thanks for joining us tonight for the home buying workshop. My name is Terrence Rogers. I'm with Carrollton Bank, and I have Maureen McEwen here with the St. Joseph Housing Initiative. And we're going to be talking about home buying, specifically for first-time home buyers. We're going to talk a lot about a lot of the down payment programs and different things that you can do to access funds. There's a lot of information. Thank you, Robert, for hosting tonight. And if you have any questions, like Robert said, you can absolutely type those in, and then he'll try to ask those questions for you guys. And then at the end of the presentation, we'll have a open, you'll be able to ask questions again. So without further ado, I have Ms. Maureen Sweeney on with St. Joseph Housing. I wanted her to kind of talk about the mission over at St. Joseph's real quick before I jump into my presentation.
Hello there, and thank you all for participating tonight. St. Joseph Housing Initiative is a 2-year-old organization. We're a nonprofit organization, and in a nutshell, we have a twofold mission. We want to help people have the opportunity to build wealth, and we also want to help in neighborhood. So we focus on vacant houses, property vacant and in need of repair, and we renovate the house. We sell them to low and moderate income families, and along with that mission, provide a lot of ongoing services and support for our buyers. Trying to sell you a house and say, here you go, I will see you later. We offer $5,000 down payment assistance that is forgivable after 5 years. We require and pay for at a home buyer education program. We also offer support at Home Sweet Home, which is a program that you can go shopping for furniture and household goods. And they deliver the same day you go shopping. So we pay your fee to participate in that program. And we also have a program called the First Neighbor, where we pair you with mentor families in the neighborhood. So if you want some, want an introduction at neighborhood meetings, or maybe you've never cut grass before and you want somebody to give you some tips or loan you a tool, we've got families that are already established in the neighborhood and who want to welcome you and help you be successful in your home ownership and successful part of the neighborhood. So right now we have been focusing in the Dutchtown neighborhood. We've renovated and sold 3 houses. We currently have 3 houses under renovation that will be ready. They'll all be ready in September. And our plan is hopefully in the next month we'll acquire 2 more. So we are on the move and would love to work with first-time home buyers.
Awesome. Thanks so much, Maureen. That's amazing. We're really proud of Carrollton Bank and St. Louis Community Credit Union Prosperity Connection are also proud to be partnering with you on their mission. It's really important not only to help people get into houses, but to have that plan moving forward. And you guys are really taking a hold of this and doing a great job with it. So thanks again. So what I'm going to do next is I'm going to jump into the actual presentation. So here's kind of our agenda on what we're going to cover today. We're going to go over the mortgage loan basics. We're going to talk about all the different programs that come across when you're trying to purchase a home between, a lot of people have heard of FHA loans. We're going to go through the features and benefits. We're going to talk a lot about down payment assistance. programs. One of the big myths on purchasing a house is how much money you need down to purchase. And you're going to find out through this class, there's not a lot that you need down with a lot of the programs that are out there to assist you. As you heard Maureen, they even have a program where they assist you. There are going to be programs throughout the city, county, private programs, and even state programs. We're going to go through all of those here today and talk about the qualifications. And then we're just going to go through the entire process and kind of what to expect, kind of some of the do's and don'ts. It's kind of how we like to do that. So the big portion of this class is really, it's focused on first-time home buyers and getting you guys ready and having the confidence in order to purchase. One of the big keys with this is making sure you have all of your ducks in a row and you feel prepared. Home buying can be really, really enjoyable if you have all of your ducks in a row. If you don't have your ducks in a row, it can be a nightmare. So if you're watching this class, hopefully you're going to take some tips away from there so that it will not be a nightmare. I'm sure you guys have heard some stories from friends or family on buying a house and how hard it was. And it's a lot of times because they didn't have the things up front. So we're going to actually talk about a lot of those things. So again, low down payment. We're going to talk about the things that the sellers can do to contribute. That's what Maureen just mentioned. And then we're going to really dive into FHA, VA, and conventional loans coming up. So what are the steps to obtaining a home loan? Really, the big key, and I mentioned getting your ducks in a row, credit is number one. The first step is to assess your credit and your finances. Really to know where you're at on your credit report. I tell everyone you should be looking at your credit report, at least every month. With all the free services that are out there, you can go to Credit Karma. There's Credit Wise. You can go to annualcreditreport.com and get a free copy of your credit report. If you haven't had a copy of your credit report, I highly recommend you going to get that at annualcreditreport.com. There you'll get the credit report from TransUnion, Equifax, and Experian. It's free and it'll show you exactly what the banks will be looking at. It's going to help you kind of determine with your credit score. That's kind of the key to getting approved for a home loan. With COVID, pre-COVID, I'll tell you, you could get a loan approved on an FHA loan as low as a 580 credit score. That was pre-COVID. Since COVID has come out, a lot of the investors have actually tightened up some of the parameters and made you need a little bit better credit score in order to qualify, just due to the way that the economy is and the financial picture and a lot of the unemployment. So right now, that 580 is about 640 for most lenders. There are a few lenders that are still going down as low as 620 on home loans, but for the most part, the majority of lenders are looking at a 640 credit score to qualify. In addition to your credit, you want to know what your financial picture looks like. I always tell everyone, when you're buying a house, even though there's going to be down payment assistance programs and there's seller programs that can assist you with the cash to close, you're still going to have to save some money and have a little bit of money saved up. That number that I have in mind is usually somewhere around $2,500. As we explore some of the programs or some of the processes moving forward, I'll show you why that makes a difference. The reason credit is so big is because everyone uses credit. Okay, the credit unions, banks, they're going to look at those for your approval terms. Someone with a higher credit score is going to get a much lower interest rate. So it's the cost of their loan, the cost of their terms overall, whether it's your credit card, a home loan, a car, it's all the same. If you have a higher credit score, then you're going to get better terms. Right now, the median credit score is somewhere around 680. So if you have a 680 credit score, you're going to get pretty good terms on a loan. If your score, while you're getting approved at a 640, you're going to have to pay a little bit higher interest rate on your loans if you have a 640 credit score. And even if back when we were doing the loans at 580, they were even higher than the 640. So having knowing your credit score and having your credit score as high as possible is going to really help you on your rates. Insurance companies, they use it for determining what your auto, life, health insurance are going to be. Landlords, utility companies, cell phone companies are all going to be looking at your credit. Sometimes if your credit isn't high enough, they may require you to put a deposit down. But if your credit is high enough, they'll waive that deposit. So those are some of the ways that credit impacts you. And of course, some employers will use that as a trigger for their hiring process. So extremely important. The ways that credit are, I get a lot of questions about how credit is factored and how they come up with those scores. And this is kind of the breakdown of the weighting system for the credit. So if you look at this, 35% of your credit score comes from your payment history. So it looks at a snapshot of your past payment history. So if you have any collections or past due credit cards or loans that have been charged off, and you haven't had good payment history, those are the things, or that's the biggest driver of your credit score. It's 35% of your score. Capacity is how much you owe on your revolving credit. So if you have a credit card and let's say that balance is $1,000 and you have $900 on there, you have 90% of your credit card used up. And that is a big no-no for your credit score. When you have credit, if you keep your balances low, under 30% is kind of a key driver that from looking at credit. If you have $1,000 limit and your balance is under $300, typically you're gonna have a decent credit score. That's a favorable credit rating for you. So if you imagine that, and then you have really good payment history on that credit card, that's 65% of your credit score right there, just by having a credit card with a little bit on there, and paying it really, really well. I've had a lot of people tell me that they don't like credit, they don't want to use credit, and I always say, hey, you have to have credit in order to really move forward and buy some of the things. Not everyone has $150,000, $125,000 in their bank account to just go buy a house. So having that credit score is what will allow you to have only $2,500 in your bank account, but a high credit score will allow you to buy that $125,000 or $150,000 house. I often say, a 700 credit score is worth more than $100,000 in cash, because if you have $100,000 in cash but a really, really low credit score and you're trying to buy a $125,000 house, it won't happen. So that's how big credit is, and that's why I talk about it a lot during this class. The other thing is how long your credit has been established. So the length of your credit gives you a better credit rating as well. So if you have credit for a long period of time and you've paid well on there and you've kept the balances low, those are the folks that are usually in the 700 credit score range when they have those three things going for them: a good length of time, excellent payment history, and low amounts on their revolving credit card debt. The other big thing that, not really a big thing, but a thing that it's actually a small thing, but something that comes up, 10% of your score comes from new credit opening up and inquiries. Often, some of you guys may have purchased a car or opened a credit card and you notice that your credit score immediately dropped. The reason for that is it's a new account without a balance, or it's a new account with a balance and you haven't made a payment on there yet. But usually when you open a new account and you make a couple payments, you will see an improvement on your credit score. I often get questions about hard inquiries and how they impact your credit. And you can you see the inquiries are only 10% of your credit score. And they really don't have a huge weight on your score. So it's not, if you're thinking about applying and seeing if that's going to impact your score, typically it'll only move it a couple points. So it's not a big, it can't hurt you too bad. In fact, when you're applying for a car now or even a mortgage, if you go and you shop around from different banks, credit unions, or mortgage companies, in a 30-day period, we're all going to see the same exact credit score. So it won't count as new inquiries and keep dinging your credit. So that's a good thing to know, just kind of going forward as you buy something and you want to shop interest rates and terms and things like that. And then the last thing is just your mix of credit. We look at the types of credit you have on your installment accounts. Installment accounts are going to be your student loans and your car. They have a set term in which they're going to be paid off. Your revolving accounts are your credit cards, where you have a limit and you can use those, and it's a revolving interest on that one. And then you can also have your mortgage. Your mortgage is also an installment account, but they're weighed a little bit different. But having a good mix of all of those is what really drives your credit score up. Okay. I know you guys may have some questions on there. Definitely type those into Robert, and we'll circle back on there. Okay. All right. So steps to obtaining a home loan. It's the first step is applying. I always talk to people about their credit and their situation and what they can qualify for. And I always say, we can have a lot of conversations, but until you apply, you really don't know exactly what you can do, because once you apply for the loan, the lender is going to ask you to provide documents for a pre-qualification. The pre-qualification is an important step to purchasing a home. You don't want to go out looking at houses and getting your heart set on buying something before you know you can be approved for it. So I highly recommend applying and looking and getting a pre-qualification letter from a lender that can tell you exactly how much you qualify for. That way you don't get your heart set on buying something and find out you can't afford it. So it's a big part of the process. A person that goes and has a pre-qualification, you're going to look really, really attractive to the sellers of the houses and also to the realtors. Most realtors will not take you out to look at homes without that pre-qualification letter in their hand. Once you have that pre-qualification, that kind of opens the door for you to go out and find a home and agree to a sales contract. A sales contract is a legal agreement between you and the selling party. Usually you would have a realtor that will work on that with you, and they would write up that contract, and you would discuss how much you would want to offer for the house. And then there's some negotiations and things that go along. And then once you have an accepted contract, that's when the fun begins on actually, getting everything ready to get your loan approved. Some of the things that we'll ask for during that underwriting process, if you guys wanted to take notes, we're going to typically ask for 30 days or your most recent 30 days paycheck stubs. And we're going to ask for your last 2 years tax returns and W-2s. If you own your own business, we're going to look at your last 2 years tax returns, and then we'll look at your current year-to-date income. We'll also look at your bank statements. We look at your most recent 2-month bank statements. So if you are looking to buy a house, and we talked about having $2,500, if you have that money in a mattress or at home or, tucked away in a safe, but it's not in a bank, I would recommend you depositing that money into your bank account and keeping that as a savings, because for the bank, that money needs to be in your account for 90 days. It'll need to be seized technically for 60 days. We'll need to, because I always say 3 months, because in that third month, we're going to get your previous 2 months bank statements. So if you have cash, you plan on using that to purchase a home, I would definitely put that money in a savings account now. Those are the main things. We look at your income and your assets to determine if you qualify. There's some scenarios that come up when it comes to income. If you have part-time income, that income, you would need to be doing that for 2 years consecutively. So if you have a part-time job and you want to use that income to qualify you for a home, we just got to verify that you've held that job for 2 years, or held a similar job in the same field for 2 years without any breaks of employment. Once we get all those things all together, there's a part that there are inspections and things that'll go on the house that you would take care of on your own. A home inspection is a building inspection, sewer lateral, there are termite inspections. There can be all types of inspections that you can get. You can do a survey before you buy the house to know everything about the house, to make sure you're not buying a lemon. But then once you do that and you're okay with proceeding, the bank would actually get an appraisal, and the appraisal would determine the actual price of the home. Once we have all those things, it goes back to the underwriter for a final approval. you check the boxes, and because you've given us everything and your credit's good, we can typically close a loan right after that. Sounds really easy, right? During that pre-qualification step is really where we'll kind of drill down into how much the lender would be willing to offer you on the loan. Basically, when you're buying a house, you're going to put a portion of the down payment in. The bank will have programs that they can offer you for down payment assistance if you qualify. I'm going to go over some of these income-based programs to tell you how much you would qualify for on the down payment side. But then we'll also talk about the monthly payments and how much you would expect to pay. Right now, if you look at rent, if you're renting a 2-bedroom, 3-bedroom apartment, your rent could be anywhere from $800 to $1,200 a month. What you'll find is on a home of about $150,000 right now, you can probably have a payment around $900. So $150,000 house will get you right in that sweet spot for what you would be paying for rent. Okay. When you get the pre-qualification, it is not a guarantee. The pre-qualification comes from the loan officer. It does not come from the actual underwriter. The underwriter is the one that will approve the loan and provide what we call a loan commitment. Usually you get a loan commitment about 10 days before your loan is scheduled to close. Typically, if you have any issues that come up, and with COVID, we had a lot of people that got furloughed or laid off during the process. They were under contract, and all of a sudden, second week of March hit, and people started getting laid off due to COVID, and they had to actually get out of their contracts. And because they got out of their contracts before the loan was committed, they were able to get all of their money that they had put down back for earnest money to hold the property. Just any changes to employment, or credit, those are the two big things that can happen that can impact your loan going through or being approved. Okay.
Hey, Terrence.
Yes.
I have a question for you.
Okay.
What information is used to determine the affordability for these 4 categories?
Oh, it's going to be your credit, your income, and your assets. So exactly what we talked about. So we're going to look at how much money you make, and we're going to determine based on your income, your credit, and how much you can put down. That's going to determine what you can afford. There are ratios that we have that I can go all day talking about, but this is kind of a high overview. Everything is kind of case by case. But we typically, I tell people, if you have a number, if you looked at your W-2, you can typically afford about 4 times whatever your gross salary is on your W-2. That's an easy way to do it, but it's not foolproof because you might have student loans, or you may have a car payment and some other debts that you have outstanding. So you just can't go off of that. It's case by case. So looking at someone's actual credit and their income, that's going to determine exactly what they will qualify for. Is that good?
Perfect. Thank you.
All right. So we talked about that. That was kind of the next the next slide here, is providing your required documents. So that's essentially the 30 days paycheck stubs, the bank statements for a couple months, your tax returns, W-2s. Big thing right now are student loans. If you have a student loan and you're currently right now, they put all the student loans on forbearances, so they all show up as zero payments. For the bank, on an FHA loan, we are still going to calculate 1% of whatever the balance is outstanding as a monthly payment. So let's say if you have $20,000 in student loans, the bank is going to use a $200 payment against your debt to income ratio. So that impacts your buying power when you have a payment like that. On a conventional loan, we will actually look at, and that's what the IDR, it's an income-based repayment or income-driven repayment plan. Whatever that payment is, so they'll look at your income and they'll say, okay, you got $20,000 in loans, but you make X amount. then your monthly payment that you need to make on your student loans will be $90. Okay, so they would lower that amount. And on a conventional loan, I can use that lower amount, even if that lower amount is zero. So I've had people that have had $20,000, $30,000, $40,000 in student loans, but based on their current income, the student loan department saw that they could make a $0 payment, basically, and that would really help their buying power if they got that. Okay, that won't work on an FHA loan, which we're going to talk about later, but it will work on a conventional loan. We have a lot of people that have things on their credit report that come up where maybe it's a medical collection or maybe an old cell phone account or utility bill or something like that. If you have any accounts and you want to dispute them and have them taken off of your credit, that's fine, because that will be helpful if it works. But if they are not taken off of your credit, they will, and you're still in dispute status, you'll have to have them removed from dispute status before we can issue a pre-qualification letter. The reason we have to do that is when you dispute account, that account no longer impacts your credit score. So if you have a higher credit score with that account being disputed, it could impact you when you remove that. And we would hate to give you a pre-qualification and have you go through the entire process, and then you remove that later on and find out you don't qualify because your credit score went from a 650 down to a 500 score due to a disputed account that was out there being disputed at the time. All right, so available loan programs. We talked about this a lot. One of the highlighted programs is the FHA loan program, the Federal Housing Authority. This program is overseen by HUD. It's a government program, and it's probably one of the most popular programs for my first-time home buyers. I would probably say around 60-70% of the customers as first-time home buyers use the FHA loan. The reason for that is it has a really, really low down payment and a super low interest rate. So an FHA loan today, the interest rate was below 2.5%, and you only need 3.5% down as a down payment. So on a $100,000 house, and let's say you don't even qualify for any down payment assistance, you could put, if you had $3,500, you could put that $3,500 down and without any down payment assistance with the FHA loan, which is pretty amazing. Another government agency loan is the VA loan, and that's for our veterans. The VA loan is probably the best loan that's out there. It has the lowest interest rate, and they don't have to put any money down. So if you're a vet and you're on this call and you want to buy, we just would have to determine your eligibility through VA. And if you're eligible for a VA loan, you can do that with no money down. And again, those rates are below 2.5% right now at my bank. They're different. Every bank is a little bit different, but right now, my bank, that's below 2.5% on a 30-year fixed VA loan. And then we have government-sponsored agencies. You guys may have heard of Fannie Mae and Freddie Mac. They're similar to just like the student loan side. It's a Sally Mae. It's like Sally Mae's brother or sister is Fannie and Freddie. So on this, they do all of the conventional loans. So you ever hear the term a conventional loan, you may have heard in the past people putting at least 20% down to buy a house. It's kind of one of the myths. You need 20% down to buy a house. On the conventional side, there is a benefit if you have 20%. You would not have to pay private mortgage insurance or PMI. PMI is on a loan. It's on the FHA loan. It's not on the VA loan, but it is on the Fannie Mae, Freddie Mac loan. If you only put less than 20% down on that loan, you would have to pay PMI. If you put 20% down on the loan, then you would not pay PMI. So private mortgage insurance is insurance that covers the bank in case you default on your loan. So you're paying that amount on a monthly basis. All right. So digging a little deeper into the FHA loan, I talked about this earlier, 3.5% down payment, 640 minimum credit score now. You'll see on some of my other slides that are coming up, I still have the 580 minimum credit score because I believe once there's a vaccine for COVID, we'll probably return to some type of normalcy, and the credit scores will go back down to that area. But on FHA, they have less strict underwriting factors than the conventional loans. Someone that filed a bankruptcy in the last 2 years, a Chapter 7, would be able to get an FHA loan. Okay, 2 years after the bankruptcy discharges, you can get an FHA loan. On a Chapter 13, it's going to be 1 year after you've paid on it satisfactory on a Chapter 13. One of the things on an FHA loan versus a conventional loan, there is a upfront mortgage insurance premium. There's a cost to do that loan. That cost is 1.75% of your loan amount. So if you do a loan at $100,000, you're going to pay the government $1,750 right up front just to do that FHA loan. And then, as I mentioned before, there's a monthly mortgage insurance premium that also goes to HUD when you make your mortgage payments. The other good thing on an FHA loan, I always like to call the FHA loan, it's a first-time homebuyer loan, and sometimes it's a second chance loan because if you've had a foreclosure in the last 3 years, FHA considers you a first-time homebuyer all over again. It's like that foreclosure never happened. So you could have a problem. Life happened, maybe there was a divorce or, the bankruptcy, something happened where, you lost a job, anything could have happened in your life. You can always recover after 3 years and get another FHA loan. On the conventional side, you see the down payment amount. It's actually a 3% down conventional loan as well. You can do that on a down payment on a home purchase. You can have a lower credit score as a 620. However, I haven't been able to get one of those approved here probably since around April, since COVID. All the policies still say 620, but we have not been able to get the underwriting guidelines to accept that for whatever reason. They do use a little bit stricter underwriting guidelines than the FHA loan on the conventional loans. On a bankruptcy, for instance, you would have to be out of the bankruptcy for 4 years. And on a Chapter 13, that's a Chapter 7, 4 years. A Chapter 13 would be 2 years. Big benefit for the conventional loan, and why, if you qualify for a conventional loan, I do that loan before I would do an FHA loan in most cases, because you don't have the upfront mortgage insurance premium. If you buy that $100,000 house as a conventional loan, you will not pay that $1,750 upfront premium that you will pay on an FHA loan. You can put as low as 3% down. Now, the interest rate is slightly higher on a conventional loan than an FHA loan, but where they make that up is on the monthly mortgage insurance premium. Typically, it's lower on the conventional loan than the FHA. So those are some of the differences on those two programs. And just kind of a recap: FHA, low down payment, low interest rates, even with a low credit score. That 580 credit score was the score that I used on this presentation pre-COVID. So I did a class back in February, and it was 580. So but now that number is about 640 for most lenders. Like I said, some lenders will go down to 620. Gifts are permitted for the entire 3.5%. And then the down payment assistance programs, which I'm about to jump into next, are all permitted on FHA loans. And the benefits on the conventional loan, again, that there's no mortgage insurance, so you don't have to pay an extra premium if you're able to put 20% down. And because there's no upfront premium, it is lower in most cases. Okay. Robert, any questions flying at all? I'll keep going.
At the moment, I'm sorry, my mic was muted.
All right. So this is the part that this is the good part right here of the presentation. This is talking about money. So this is really going over a lot of the approved agencies that are out there that offer down payment assistance. My bank, we are members through the Federal Home Loan Bank. We have a program called Down Payment Plus. It offers up to $6,000 in assistance for first-time home buyers. And the way that the program works, it's a matching program. We match 3 times up to $2,000 that you invest in the loan, and that's how you get $6,000. So we go, if you put $2,000 in times 3, you get $6,000 from the bank. So right there, to buy a house, if you have $2,000 and you meet the qualifications on the income that I'm going to go over, and you have the credit score requirements met, you will qualify for $6,000 in assistance through this program. There are additional programs through the state. Missouri has MHDC and Illinois has IDA. These are state programs. The MHDC program provides 4% cash assistance, which I'm going to go over that one in depth. And the Illinois IDA program, depending on what county you buy, some programs are $5,000. They have programs all the way up to $10,000 for first-time home buyers. And then in addition to that, you have local programs through the city and the county. If you buy in St. Louis City, there are programs where they will assist and with tax abatements for certain houses. There's some down payment assistance money that comes available. The city typically runs out of money pretty quick. They have a limited amount and they run out pretty quickly. St. Louis County, I've not heard of St. Louis County running out of money in quite some time. They used to run out of money usually around August or September of every year, but the last few years, St. Louis County has had money. St. Charles County has had money. Jefferson County has had money. So in St. Louis, you're pretty, you can pretty much, if you qualify based on some of the income limits I'm going to go over, you can definitely take advantage of these programs as a first-time home buyer. A lot of the organizations that administer these work closely with Better Family Life, Beyond Housing, Urban League, and Community Action Agency of St. Louis County. It's long, so I had to abbreviate that, and we'll just call them CASEL. There's also some not listed, Housing Partnership, Lee May Housing. There are a few other places that offer these programs to tap into some down payment assistance. The really, really cool thing about this is if your credit score is high enough, and typically when I say high enough, if you have above a 680 credit score, I've been able to use all 3 programs together. So I've been able to use my Down Payment Plus program offered through my bank, the MHDC program, and get money from St. Louis County or St. Charles County. You definitely need a minimum 640 credit score to qualify for any of the programs. But if you have the higher your credit, the more likelihood of you being able to qualify for multiple programs. And really, it just comes down to what your income is. So this is kind of my flyer. Our Down Payment Plus program gets you up to $6,000, as we mentioned. It says you need to contribute at least $1,000 of your own money to purchase, and you have to participate in a home buyer's education class. And it can be done online, and you can do a counseling over the phone. We've actually modified a lot of that due to COVID. Pre-COVID, we would tell you to go to a class at Better Family Life or Beyond Housing, Urban League. But with COVID, we're doing a lot of that online now, but you can still talk to a counselor. That is a requirement. Then you also have to live in the house as your primary residence. For our program, we want you to live there for 5 years. It is a forgivable loan is what it is. So as long as you live in the house for 5 years, you don't pay a dime of the $6,000 back. And definitely call me if you have any questions on that. Our program, typically we have funds through August. So we're getting down to the end of our program. We get funds usually the first week of January, and they last all the way through the home buying season. And typically we're out by the end of August, early September. Here are the income limits for the homeownership down payment assistance program. So these income limits, they're based on the housing size. So how many people will be living in the house? And we go off of your gross salary. So for my Down Payment Plus program and for all of the St. Louis County, St. Charles County, St. Louis City, Jefferson County, they all use these income limits. These are the household income limits set up by HUD. They came out in April. Every year in April or May, they usually increase these limits by a couple $1,000s. So last year, for a single person buying a house, it was $44,000. It went up this year to $46,450. If your income is below that limit, then you would qualify for the $6,000 down payment program. If your credit score is at the 640, you'd also qualify for MHDC, and you could qualify for funds through Beyond Housing or Better Family Life, or Castle. If you are a family of two here, it's two of you in there, then you would have to make less than the $53,050. Family of three, below $59,700. So this kind of, if you know what your income is, look at your W-2. Or what you're on track to make. These are the numbers that you're looking at to determine if you qualify. Okay.
Hey, Terrence.
Yes.
So I got another question here. The question is, does this include people who are not on the loan application?
Yes, it's total household income. So even if they're not, if they live in the house, if it's a married couple and you're only getting a loan in one person's name, then then we still look at the second person's income. So it's total household income. We'll actually look at any income over the age of 18. So even if your kids, if you put them on your application and they have a part-time job, we'll have to count that income as well.
Terrence?
Yes.
It's Maureen. Can I just add something here in that?
Yes.
These are the same income guidelines that St. Joseph Housing Initiative uses to qualify as a purchaser for one of our houses. But I also want to be sure that we make the point that our $1,000 down payment assistance is also a 5-year forgivable loan, and it can be combined for
Perfect.
Is that correct?
Yep, that is.
Okay, great. That's a nice down payment assistance, $11,000, right?
Awesome. It's amazing. All right. So the next program I talked about is the MHEC program. So if we're talking about somebody and you looked at the other one and said, man, I make more money than that, the MHEC program is the one that you would probably look at. The income limits on the MHGC are here. So if you look at the St. Louis incomes right here, for a 1 to 2 family household, you have to make less than $82,900. And you can kind of see this counts all the, Franklin County, Jefferson County, Lincoln, St. Charles, St. Louis City, St. Louis County, Warrenton. If you're over 3, then you have to make less than $95,000. So if you got a family of 4, 5, 6, if you make less than $95,000 combined household, and again, this is who's ever living in the house, even if they're not on the application, we'll take into account their total income if they're going to be living in the house with you. There is another program called the Next Step program. And this is for people that are not first-time home buyers, but a first-time home buyer that makes a little bit more money can still qualify for this program. The only difference is this program, if you get the Next Step program, the income or the interest rates are a little bit higher than the program for the first place program with MHDC. You can kind of see down here, you can go on a single family home, you can go all the way up to $294,000. And you can get 4% assistance. That's about $11,000 that you'd be able to get in assistance from MHDC. So if you don't meet the income limits on the Down Payment Plus program, these income limits here, typically I can use this program for the folks that don't qualify over there. Okay. So there's some good news. All right. So kind of in a nutshell, on the down payment assistance, you have to meet the income eligibility requirements. So, and that's what I was saying, if you qualify for the Down Payment Plus or the St. Louis County funds or the St. Joseph Housing program, you'll also meet the income limits for the MHCC program automatically because they're higher. Typically, you're going to have to contribute at least $1,000. So I mentioned having about $2,500 saved up. That's kind of a key number. But if I've had people that have had less than that, you just won't get as much money in assistance from us because we only match 3 times on our program. But for St. Louis County, St. Charles County, they want you to definitely put at least $1,000 in on their programs. And I believe, Maureen, I think you guys have that same criteria on the St. Joseph Housing program as well. You have to participate in the home buyers education and financial literacy counseling, and then live in the house as your primary residence. Those are kind of the key things there. And I always tell everyone just as Maureen was saying on that one, that program was around $11,000 between just our 2. Typically, I'm seeing anywhere from as little as $3,000 up to $15,000 in assistance for a first-time home buyer on average. Okay. So, Maureen, did you want to talk a little bit about some of your? This is the map of the St. Joseph housing kind of territory.
Sure. We office out of St. Mary's High School and are focused on the area surrounding St. Mary's in Dutchtown neighborhood. So so far the 6 that we've done are an area we're about to acquire. That's our focus area right now.
Okay.
I think that's.
Yep. And then you want to talk a little bit about this is one of your houses here.
So that's one that's sold a couple months ago. That's on Alaska. We had 2 houses side by side on Alaska. Sold. So anyway, the point I really want to make about our anybody interested is that we make sure that all house are on our buyers to be successful, and not we make sure that the heating, cooling, roof, plumbing, and the electric, everything's typically put in new kitchens and bathrooms. Most on their condition. We just don't want our buyers to have any surprises and major expenses in the first several years of owning a house.
Awesome. So I just threw on the slide again, Maureen, you mentioned the first neighbor program earlier. Did you have any success stories on some of the people that have moved into the neighborhood and kind of connected through the first neighbor program?
Well, we have 2 new home buyers over this summer so far, and it's been a challenge because of COVID, but it's been so wonderful because we changed it up a little bit. Rather than having just one first neighbor, we have a team of neighbors because they bring a variety of talents and interests and abilities to the group. And our buyers were so touched that even through emails or phone calls, whatever, through COVID, we were still able to connect people and help them feel welcome to the neighborhood. So it hasn't quite worked out exactly according to plan this past summer, but I have hopes that it will be a little bit more personal in that we have some face-to-face meetings. But in spite of it all, I think we're able to help our buyers feel like they're not just in it alone. And we had two single women buy the houses, and both first-time home buyers, and both excited and scared about the prospects. But I think so far it's going really well.
Awesome stuff. So here, this is just a slide here of some of the homes that are out there, and I think you'll see the 3 that have sold there, South Grand, the one in Alaska, and I guess a couple in Alaska there all sold. And I wanted to kind of give you guys that are on the here an estimate of what the payments and the cash to close would really look like on those houses around that 125 range. Not all of them are right at 125. There's some were a little bit higher, but I want to just kind of keep it simple. The interest rate today around 2.75 is what I use, even though rates actually dipped down below that. But when I did this slide, it was at 2.75. A total payment on that house, which includes the taxes, insurance, everything, on a $125,000 house, you're looking at a payment under $800 a month, which is under renting. So if you remember, earlier I mentioned if you bought a house under 150, you'd be under $900. It's pretty amazing. Right here, down payment assistance. I talked about our program, $6,000. You got $5,000 on top of that. For this 125, especially on a St. Joseph house, all you would need is roughly $2,000 in order to buy a house at 125. So we go back to these houses that are, on Mount Pleasant and Idaho and Alaska. You could be looking at payments under, under $1,000, I'll say, and somewhere around, that $2,000 to $2,500 in cash if they went all the way up to 150. So just pretty amazing stuff. There's that buyer investment. 2,500 is kind of a rough number. I put that in red because everything's a little bit different for each buyer. Sometimes you might not be 2,500. It could be as low as 2,000. But just some really cool stuff to think if you're renting and what you're paying in rent. You're talking about building wealth. For your family. Not only are you going to have the ownership, you're going to be building equity, which is also going to be for your future. So, which is really amazing. All right. So here are my 10 commandments of buying a home. So these are some of the things, we've talked a lot about credit and what you need to do, what you can expect. Here are a lot of the things that you should not do. And that could cause you not to be approved. I've had all of these things happen to me in my 20-year banking career. Thou shalt not change jobs or become self-employed or quit your job. Yes, even if you are going to get a promotion, if you're under contract, and this is what this is, if you are actually under contract, you have an agreement to buy the house, definitely do not change jobs or quit your job or become self-employed. Someone that's self-employed, they need to be self-employed for 2 years before we can use the self-employment income to purchase a home. Don't buy a car, a truck, van, or motorcycle. We talked about earlier, we're going to look at your credit. We're going to determine what you have, what you owe, and that's going to determine what you're pre-qualified for. Well, if I give you a pre-qualification letter for 150, but then you go out and buy a car and the car has a $450 payment, you may not qualify for 150 anymore. And then you write a contract and I have to tell you, I'm sorry, you bought a car. I can't approve you. So don't use your credit cards excessively or let them fall behind. I've had people that have missed a $27 Discover payment or, just forgot to mail it in and it hit their credit and that caused their credit scores to go down. And they went from being able to be approved to not being approved on a loan. So once you're under contract, make sure you're paying all of your bills. Don't, take a deep breath and stop paying your bills. Make sure everything's up to date. Don't spend the money you have set aside for clothes. I have a lot of people that I've pre-qualified, usually around February or March. Maybe they got their tax refund and everything's going great. And then they send me their bank statements and they have $3,000-$4,000 in there. And then they write a contract and tell me that they went on vacation and they spent all of their money that they had in their bank account. Don't do that. That's bad. All right. Don't omit debts or liabilities from your loan application. What that is, if you have any debts, if you have any liens, judgments, anything that you think might come up later on, and maybe it's not on your credit report now, but man, you're thinking, man, you know what? There might be this apartment complex that I had some issues with, because the loan officer is only a part of the credit part of it. There's going to be a title company that also comes into play, and they're going to pull to make sure you don't have any liens or judgments, things that might not be on your credit. So just know, when I talked about getting your ducks in a row, if you think you have anything out there, or you've gotten a collection notice, I'd be trying to settle some of those things and get those things squared away, especially if they are judgments, if you've been sued, if there's a lien or something like that filed, if there's any delinquent taxes. All of those things, they may not show up on your credit, but they will show up when the title company goes in and looks and runs title on your, to see if anyone sued you or anything like that. Don't buy furniture. I've had people buy furniture before the loan closes, and it's opened up a can of worms where that's a new debt. It's almost like buying a car. Typically, once you get started on the process, you do not want to purchase anything. You just want to wait until you close to start buying anything else. Unless you use cash, don't use credit to buy anything, and don't use the money that you're using for your down payment as well. Don't originate any inquiries on your credit. Again, that's kind of a duplicate there, but don't make large deposits into your checking account without letting your loan officer know. The reason we say that, if you have cash, we can't use cash. So don't use the money. If you deposit cash into your account, we will not be able to use that cash to qualify you. Don't transfer funds or change bank accounts. So if you have money in several different bank accounts, if you start transferring money, this is probably the biggest headache that a lot of people say, man, the bank is really, they're really nosy. They're all over me. They want this, they want that. It's because with the Patriot Act, we have to verify where all the funds go to make sure it's a government-sponsored agency that's doing that. We're making sure that all the funds are legal funds. So that's why we can't use cash. We don't know where the cash came from. We have to use money that's already in your account, or you're getting from your payroll, or you're getting from your savings. You can use your retirement, but definitely no cash. Last thing, and this is don't co-sign for a loan for anyone. I've actually had several people actually go out and co-sign for a family member, or not even a family member, for a friend, for a car loan or something, and that's caused them to not be able to buy a house, because even though you co-sign and they're going to be the ones that are actually the primary borrower, we still count that co-sign payment against you, and we can take the co-sign payment off if you've had that co-sign payment for over 12 months. But if you just open up a new account, we won't have 12 months to verify that. So definitely do not co-sign for anyone throughout the process. So those things are some of the pain points for us when you're trying to buy a house. If you're thinking about all these things that you don't do, you're keeping your ducks in a row by not doing these things right here. Okay. All right. And the last one are questions.
Terrence, I think you covered all the questions here that I had.
All right. Well, we're ready to rock and roll. Thanks for having me, Robert.
No problem. Thank you for coming out. Thank you, everybody, for joining us today. Once again, my name is Robert Nelson. The guest today was Terrence and Maureen. Thank you all for attending, and thank you all for hosting with us.
Robert,
Yes.
thank you.
Oh, no problem. So, please, if you all could mark calendars for our next class we have coming up on 30th, which is next Thursday, and that will be over identity theft. You can see how to protect your credit against identity theft. And thank you all for tuning in. You all have a wonderful rest of the night.
Thank you.
No problem.